Ever wondered about the invisible rules that hold the world of accounting together? Those invisible rules, my friends, are what we call accounting principles. These principles are the backbone of all accounting practices, guiding accountants to record, analyze, and present financial information in a standardized way. So buckle up as we take a thrilling ride into the world of accounting principles. First up, we have the cost principle. This principle requires that when a company acquires an asset, it records the asset at the cost it paid for it, not its market value. So, if a business buys a piece of land for $50,000, it records the land as an asset worth $50,000, even if its market value is higher. Next, we have the revenue recognition principle. This principle dictates when revenue gets recognized in the books. Revenue is recognized when it's earned, not necessarily when cash is received. So, if a company sells a product on credit, it recognizes the revenue at the time of sale, not when it receives the payment. Then, we have the matching principle. This principle ensures that companies match expenses with revenues. In other words, it records the expenses in the same period as the revenues they help generate. If a business sells products in January but doesn't pay for the inventory until February, it still records the expense in January. The fourth principle is the full disclosure principle. This principle requires a company to provide all necessary information in its financial statements so that users can make informed decisions. It aims at transparency, ensuring that there are no hidden facts or figures. Finally, we have the materiality principle. This principle allows accountants to ignore other accounting principles if the net result would not mislead users. For example, a company might expense a small asset immediately, even though the asset could technically be depreciated over several years. Now, let's gather up the key points about these principles. The cost principle requires companies to record assets at their purchase cost. The revenue recognition principle dictates that revenue is recognized when earned, not necessarily when cash is received. The matching principle ensures that companies match expenses with revenues in the same period. The full disclosure principle requires a company to provide all necessary information in its financial statements. Lastly, the materiality principle allows accountants to ignore other principles if the net result wouldn't mislead users. Understanding these principles is like having a secret key to unlock the mysteries of accounting. They provide a universal language that accountants use to communicate financial information. By grasping these principles, you gain a strong foundation in the accounting world. So, next time you see a financial statement or hear about a company's financial performance, remember the principles behind the numbers. They are the invisible rules that shape the world of accounting.